beliefs. The number one market is always number one in this survey, especially when the economy lags, so it's no surprise that Washington's on top. The market has bounced back to the point now where some investors may be overpaying for well-located core trophy-like assets. But you can't argue with the security of doing business with a vast federal jobs engine that does not do layoffs no matter who's in power. New York's job growth outpaces most other markets thanks to a renewal in the financial services industry. The office and the hotel markets have bounced back. Prime co-op prices have held up. Apartment landlords are even starting to have some pricing power. Filling out the top 5 markets are very familiar names, the ones that are perennially in the lead positions. All of them share certain characteristics. They're global, coastal gateways. They all have 24-hour cities. Also in the top 10 this year are 2 Texas markets. Interviewees like Texas because it's got a business-friendly environment, and 2 Southern California markets. No one is ever going to bet against LA or San Diego, despite what the state is doing to struggle through its financial crisis. What's really interesting to notice here is that year over year, between 2010 and 2011, the green, the not-so-bad ratings, have replaced yellow in a substantial amount of our survey ratings. You can see here, if you look at this chart, how the coastal markets fare much better than the interior cities, and how growth is oriented towards the Sun Belt. And that's the investors believe that's going to perform much better than the North and the Midwest. These are the trends we've noted for years. Also, with all those yellow and red dots, what you'll see is, if you count them up, more than 50% of the cities fall below fair investment ratings. So while things are getting better, clearly, we have a long way to go. Interviewees continue to gravitate in their thinking to a handful of markets: the gateways along global pathways, the 24-hour cities, places with geographic barriers to entry. Because this is where the high-paying, brain-power jobs concentrate and where the young people are going to go to build their careers. Downsizing parents are moving back into the cities for greater convenience. This leads investors' attention to these markets. They have greater liquidity and therefore get premium pricing. The East Coast has 3 dominant 24-hour cities which are relative investor hotspots: Washington, New York, and Boston. Certainly no surprise there. You go to the West Coast, 3 cities, San Francisco, Seattle, and LA, outperform all other markets. Again, investors want to stay close to the coast. No surprises there. You see a mixed bag when you look at the Southwest and the mountain states. Denver progresses well as it builds a 24-hour core helped by its light rail. Houston gains as the energy capital on a global basis, and its port is going to benefit from the widening of the Panama Canal. Phoenix and Las Vegas, which are drowning and overbuilding, now need to worry about not having enough water to continue to grow. Overbuilding, as we all know, affects investors' psychology when they look at Atlanta. But Atlanta remains the city with the major gateway airport, which other cities in the regions don't have, and a lower cost of business environment. So it maintains its popularity. The Research Triangle continues to attract the brain-power jobs. Charlotte benefits from being affordable and having a business-friendly economy. The housing bust continues to hold back Florida. Again, no surprises here. When you look at the Midwest, only Chicago stands out, as most of the other cities have had dramatic job losses. Chicago has an airport, has the distribution facilities from the industrial empire built around O'Hare, and has 24-hour infrastructure, and that keeps it viable in investors' minds. Many markets should hope for an outcome like Pittsburgh. Here's a city that rates low on our survey for investment prospects, but has transformed itself from a manufacturer to a city dependent on government and quasi-government related jobs, universities, knowledge, and medical centers. The metropolitan area isn't growing much. Development opportunities are few. Rents and values don't move a lot. But vacancies are low. The quality of life is good. Pittsburgh, in fact, is really on the leading edge of what will be this upcoming era of less. As we shift to the property sectors, everybody falls in love with rental apartments, the new king of core style income generating investments. Everything else trails. What you normally see in this part of the cycle is this noticeable uptick in hotels last year, the biggest change year over year of any of the sectors, while suburban office continues to lag the most. Apartments have everything going for them, whether it's demographics, demand from young adult echo boomers, housing refugees who can't afford to own homes or don't want them anymore, moderate but increasing development, and readily available financing from Fannie and Freddie. And if immigration starts to pick back up, that'll be another plus going forward. On the office side, investors continue to bid up the trophy properties in the 24-hour markets and seem to steer clear of everything else, especially those commodity suburban office buildings. Big companies focus their headquarters in the global gateways near major airport hubs. Back office locations, which used to be in the burbs, can now be any place. Space per capita continues to be squeezed down from 200 to 175 and less. Tenants begin to lock in deals to take advantage of reduced rents, but what's not happening is they're not taking any additional space. Opportunistic investors are focusing on hotels to bounce back much faster when a recovery takes hold. That's what usually happens. They favor the full-service hotels. They stay away from the high capex resorts and the oversupplied limited service sector. Industrial markets are starting to recover from an area from record vacancies, and while the best markets continue to be the gateway seaports on the east and west coast, we're also seeing a lot of activity in the major interior international airports. The expanded Panama Canal certainly will help the Gulf Coast as well as southeast ports, and it'll start to redirect some traffic from the Pacific area, which has been, literally ships waiting at sea for weeks to come in to unload. If we turn to retail, the fortress malls and the infill grocery-anchored retail have held up much better than people expected. But look at the overall vacancy rate and consider the following. There are no regional malls under construction anywhere in the United States today. Hard to believe. That says something about the need for retail and the direction of where the major tenants who drive the malls, think the market is going. The lifestyle center craze seems to no longer have as much currency as it used to have. We're starting to see some construction markets in the tight infill apartment construction in some of the tight infill markets, and maybe the start of an office building or two in a 24-hour city. But certainly land costs and construction costs are down, but so are values. And in most markets, you can buy existing properties at better yields on a risk-adjusted basis than you can if you want to buy some, if you want to do new construction. There are some best bets. You would have thought that there would be nothing good to say, but there are some places and directional opportunities that we found from talking to people nationwide. Obviously, by cash flow assets, income returns and appreciation are going to follow as we see a recovery. Lock-in leverage. Rates cannot stay at these levels forever. Certainly, the prediction is that they'll stay this way through most of 2011. But 2011 will end also. Borrowers need recapitalizing, so the opportunity is to find properties you like with borrowers who have upside-down financial structures, step in and provide that rescue capital. You need to focus on the gateway cities, the 24-hour marketplace. Infill continues to get more investor attention over the fringes. REITs have had a good run, but will continue to provide good dividends during the rest of this cycle, and they're really well positioned to be accretive buyers when properties come to the market because they have huge resources available to them. Land certainly can't get much cheaper, but remember, you're going to have to wait to do something with it. And so you have to be prepared to be really patient. Looking at development, it's time to continue taking that siesta or snooze or export your towns to emerging markets which need new space. We're probably still 3 to 5 years out before we start to see any real pickup in activity in the construction zone. For the property sectors, apartments, industrial and infill neighborhood shopping centers, they're all buys or holds because of their solid cash flow performance and because you'll have lots of liquidity in those spaces. Malls are solid too, but the big REITs just aren't sellers, so I think you can take them off your list. In any cycle, there's usually a brief window at the very beginning for hotels, and we're clearly there, but our participants say focus on the full-service hotels. If you can find trophy assets, trophy office buildings in the gateway markets, you should buy them, but suburban office should be avoided. And for anyone looking for that dream condo, that dream house, that co-op, whether it's in the mountains or at the shore or literally in your own backyard, probably now's the time. But if you're going to speculate in the single-family residential area, be prepared. Housing prices are not going to go up very quickly. For the